We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Tavi Costa, portfolio manager at Crescat Capital. How are you today, Tavi?
Great, Tom. Thanks for having me.
Great to have you back. It's always good to really get your sense on where everything is. You guys do a great job of, I think probably the best thing is looking at all of the charts that you put out on Twitter and seeing just how dramatic some of this time really is. So I was thinking maybe we could start by looking at some of the macro picture. Are we starting to see really the effects of rising rates throughout the world when we look at, for example, the Bank of England having to step in and save its pension funds there last week?
Yeah, I mean, I think we're facing an environment that probably we've never seen before in terms of the withdrawal of liquidity in markets. There's really three things going on all at once. It's this huge withdrawal of liquidity from central banks in developed economies, and you have this rise of interest rates in global bonds as a result have been collapsing, and not only in the short end or in the front end of the curve, really across the entire curve. And the third one is the dollar. This move on the dollar has been, kind of relentless, and I would say we probably never seen those three impacts in the economy that way, and it's unsustainable. I think we all know that all those three issues are unsustainable given the fact of how much debt we have in the economy. And we now have a separation of three parts, three groups in the economy right now, in the global economy, which is we've got countries like Japan, which have been suppressing their cost of debt. In other words, pegging their 10-year yields at 25 basis points, buying unlimited amounts of their JGBs, and at the cost of their currency. So their currency has been collapsing. So you have suppression of rates and letting the currency go. The second group is sort of where I think the US is, which is really focused on price stability and at the cost of their bond market. So you're seeing interest rates rising in the US for many reasons. It's not just a Fed policy, but one of them has to do with the way they're behaving towards the problems that we have, and so you're seeing a strong currency in front of that. But as a result, you're also seeing a treasury market having one of its worst years in many decades. And then I would put Brazil into that bucket as well, because Brazil has been very focused on inflation early on. And you're seeing sort of the same situation with their bond market, not as severe, but at the cost of, not at the cost, but with very much focus on exchange rate. And then you have the third bucket or third group of countries that I think it's the most severe one, which are basically letting their currency go and their bond market go. You got the ECB probably being the leading one in that front. So you have most of the European bond markets have been collapsing, and at the same time you have the euro doing the same. And you got now the BOE trying to join Japan on the front of maybe suppressing cost of debt, which I think will happen. And at the cost of that, you're seeing the British pound collapsing. So those three groups are very becoming more and more pronounced, in my opinion. And then you have China, which is kind of uniquely in trouble, in my view as well, with the amount of leverage that they have, which is also the case with Japan and Europe and other countries, but with a very different government leadership, which in my view has always been, in a way, a real credit imbalance that will translate into a severe devaluation of the Chinese yuan. So that's sort of the backdrop we're in, with countries that have commodity-led economies maybe more favorably being, benefiting from this macro backdrop, and other economies that are more commodity importers, like the UK, like Japan, like China, suffering from that. So that's big question, but that's kind of where my mind is right now.
Mm-hmm. Yeah, I like the way you kind of split that into three separate parts there, and it really shows the differences, as you say, between commodity exporters and commodity importers. But last week the US released a stunning jobs opening number, and it was dramatically negative. So could this be the start of the jobs and labor market data showing the lag in the Fed basically needing to engineer a recession to combat inflation?
Look, I've been of that view. I think the labor markets are the next shoe to drop. And certainly, I think even the Fed policymakers also have a similar view that that's probably going to happen. But I think the degree of or the magnitude of that issue may differ, meaning I think it's going to be a lot more severe than they do. When you look back in the 70s, and I don't think the 70s is a perfect analog, but I think it's important to go back to times when you have inflation persistently growing in the system. And when you look back during those times when CPI was growing, which is also not a perfect gauge, so keep that in mind, those caveats. But what's happening, I think, is after 2 years in the 70s, after CPI started accelerating, you began to see the deterioration in labor markets. And I'm speaking mostly about unemployment rates specifically. And so you're starting to see some things that have changed recently in the margin, especially I would say job openings is a big one. Initial jobless claims have started to rise and then decline a bit recently, but it's probably going to continue to rise from here. Continuing jobless claims will probably show the same. We're seeing a number of layoffs already, but I think it's most of labor markets gauges are certainly very lagging indicators, and unemployment rate is no different. And so it's a little crazy that policymakers are focused so much on that, particularly just given the fact of how that's going to show in the data a lot later. But that it is what it is, and we're not here necessarily change the way they think. So we have to apply that in the markets. So in my opinion, this withdrawal of liquidity that we're seeing it's hard to believe the economy is not going to collapse here in the near future. And so I've been of the view that the consumers have been in sort of a breaking point for many purposes. And one of them, it's not only the tightening of monetary conditions, but it has also a lot to do with what's happening with savings rates and mortgage rates, savings rates being at historical lows. And then you have the fact of mortgage rates increasing. So they're getting squeezed by all fronts. And on top of it, you have a Fed, laser focused basically on price stability until you see unemployment rate, which is a hugely lagging indicator, start showing issues, which will probably show issues in the next 6 to 12 months. And then until then, I think things are going to be in a much more fragile state. And it's hard to believe, let's say corporate earnings are not going to collapse from here. And you look at corporate earnings estimates, they're still supposedly growing as far as what they expect in the next 1 to 2 years. I think that's almost I think it's almost impossible to see that here. There's a lot of re-rating of prices in terms of risky assets, equity markets, junk bonds to unfold as we see those imbalances also being unleashed. And so, yeah, there's a lot of things going on, but I think there's further downside for equity markets given that focus in policy making on unemployment rates.
Mm-hmm. Tavi, I'd like to concentrate a little bit more on that. You're saying that the corporate earnings are very likely to miss, over the next, let's say, 2 to 3 years from some of the projections. Do you see let's say the next chapter of this bear market being marked by a blowout in corporate default risk as well?
Yes, I think that has to happen. This disorderly sell-off and dysfunctional market and economy needs to happen in order to see a big change in terms of the policy stance from the Fed. And so I don't think we've seen that yet. Majority of the move in the corporate bond markets has been driven by duration. How do you see that? Look at credit spreads. Credit spreads are still very low. When was the last time the NASDAQ was down 30% or so? and credit spreads are still sub 2%, never. So I think that's the next issue to develop here, where you start seeing, corporate bond markets really collapse, not because of the duration risk. In other words, not because of the rising interest rates, but really because of the risk of default, which we haven't seen that really be reflected in prices. And I was just reading the Wall Street Journal this morning. We're starting to see now startups being worried about issuing equity at much lower valuations. So they are starting to issue debt instead. That's kind of new, right? I mean, it's new meaning we haven't seen this in the last 10 years or so in terms of that part of the market. So companies are starting to lever up at the wrong time with cost of debt a little higher than it was. It could get a lot more expensive. That's why I said a little higher. And so I think this is it kind of as a snowball problem. I mean, it's just developing as we speak. Venture capital is down somewhere close to 60% from its peak. I mean, this was a very one of the leading parts of the markets. And you start looking at that, Tom, which I think it's really interesting. Like I remember being worried about Chinese stocks. And they peaked back in 2021, around February and January. Some of the stocks peaked around there when you had that crackdown, ADRs and so forth. And the technology companies in China started to decline. Right after that, and almost immediately, actually, you saw ARK Investments peaking. And then a couple months later, you saw most of the non-profitable businesses. But really, it wasn't just that. It was really software stocks that actually make money, but were trading at ridiculous multiples, begin to also decline significantly. And so now you look at those vehicles and also those investments today in terms of where they are now retesting. Chinese stocks are 6-year lows. You have ARK Investments now where they were back in March lows. You have a lot of software companies also close to March lows. You have things like Netflix already near March lows as well. So is that the roadmap here? I mean, I think it is. Is that the roadmap for where equity markets are going? I really do think that that's the roadmap. I think we're yet to see the big flush in equity markets, meaning seeing NASDAQ down in some big numbers, not 3-4%. I'm talking about 5+%, like those big flushes that we used to see some other times. They're not normal. They're very unusual, but I think we're going to see those. And that's when markets become very dysfunctional and people lose faith. And that's when the Fed is going to have to step in. And as we see that developing, we may see some other investments begin to decouple from that. Maybe gold will start decoupling and other things as they start sniffing that central banks will have to change their stance. So I'm focused on that side because I think that's the kind of the playbook here going forward.
So, Tavi, if and when we do see a recession, won't we end up seeing the fiscal deficit to GDP increase further? And what downstream effects can that have?
I believe I did a research that showed that about usually in average in the last 40 to 50 years, the deficits increase about 6 percentage points during a recession. At least that's what happened in the prior times. And so I expect to see something along those lines. And this is a big question because if you think about the amount of issuances we're seeing on treasury markets, which, we discussed this before, and I was very concerned about the amount of issuances, not only in the front end, but really on the back end of the treasury market. So you see quite a lot of issuances happening in 10, 20, and 30-year treasuries. And it's more than we've seen in any other time in history. And it's because of the deficit problem, but also due to there's also a demand issue that is not really serving the amount of supply being really put in the markets right now. And for many reasons, I mean, the Fed used to be the largest buyer. It's not the largest buyer anymore of those instruments. And then you have U.S. banks are now, for the first time in a couple since 2014, I believe, now net sellers of treasuries, which is a big change. They were supposed to be the ones picking up the slack from the Federal Reserve. We're not seeing households to step in and buy those treasuries either. The geopolitical issues that we're seeing globally with Russia and Ukraine, China, Taiwan, and so forth in the Middle East and many other parts of the economy, of the global economy, are not really favoring purchases of treasuries. As far as, in fact, we're seeing quite the opposite. Those economies are being forced to sell their international reserves to really protect their currencies. And so the deficit question is important because the fiscal agenda has never been more extensive. I mean, you have peak inequality, you have the issues with green revolution, where most of governments want to spend a large amount of capital onto those developments. You have this risk coming from China, where we used to use China as our manufacturing plant globally for everything that we built, and now we're starting to lose or at least attempting to reduce the liability from China. And this is not just the U.S.; it's really developed economies. And just getting into that topic, to me, I remember seeing for instance, the commodity producers capex chart 3 years ago. I was one of the first people to really start posting those charts. Mm-hmm. And I think there's a even more important chart that in the future, a lot of people will be posting. They're going to be showing Germany and France and the US and Canada, showing their manufacturing side of GDP relative to GDP overall, which in the US used to be 30% back in the 70s, the 60s, and now it's only 10. And so as you see us moving back to from China to really reshape the manufacturing plants in the U.S., we're going to see that the manufacturing percentage of GDP starting to rise. And I thought this was going to happen with Trump, but it didn't really happen. At least the conversation began, but in the data, we didn't see that move really happen. But now I think it's starting, and inevitably we're going to see a big increase of that. And that chart is absolutely critical because as you see this kind of a reshaping of manufacturing in the US and other parts of developed economies, guess what? We're going to need cement, we're going to need copper, we're going to need every base metal you can think of in order to rebuild those things. And so that's going to be the next wave for raw materials, for tangible assets, for commodities that I think is yet to play out. So, it's a lot to unfold, but there's quite a lot of opportunities given what's happening globally here right now.
Mm-hmm. So moving into, let's say, some of those opportunities, is energy really the only sector that seems to be performing positively in this market environment?
It is interesting to see that divergence that you're referring to from the rest of the market on energy, which I think it's been always my view that the commodity cycle is predicated on the capex cycle of those businesses, and certainly that's the case. I mean, well, people are quite worried about this as 2008 again, where oil rise in prices and then crashes along with the economy later on as we see the deeper part of the recession. And maybe that's a possibility. I do think that the imbalances back in 07 and 08, given the fact where, if you look at aggregate capex for the energy sector or any other part of the commodity sector, you can see clearly we're right at peak at those times. And if you look back today, adjusted for GDP, capex is still at now just made new lows. And I'm adjusting for GDP because the same $10 million we used to spend back in 08, it's not going to get to what it used to get to today. Labor markets are more expensive, infrastructure is more expensive. And so you have to adjust for GDP because you adjust for inflation at the same time and the size of the economy. And that is at new lows right now. So if you think about that, it's hard to believe there's a major downside for commodities as a whole. Yes, they can get caught up on cyclical commodities can get caught up on the demand side. That's certainly a possibility, but that would be a huge opportunity if that happens for investors to be allocating capital in that dip. So I've been, I think that's if you think about the oil market today, what is going against it, it's insane. I mean, you have China imploding. Basically, that's the largest importer of oil. You have the U.S. selling its strategic petroleum reserves. You have the Fed tightening like at least it hasn't tightened in many decades here.
Mhm.
And the economy is basically also, in my view, now entering a major contraction of growth. And so, how in the world is oil is still at the levels that they are? Well, that reflects on how supply is very tight. And so, and you have geopolitical situations also still, I think still quite severe happening. And so it's difficult to not be bullish on oil. Obviously, the risk of being bullish on oil versus other non-cyclical commodities is maybe more attractive to be long those versus oil. So you have to size the investment accordingly with the risk. But I still think, when you're trading oil companies still trading at, you can easily find companies trading at 10, 11, 15% free cash flow yield, paying 10%, 15% dividend yield on top of it. It's just a complete opposite to what we saw at the peak of the market back in 2014, 2015. We were short oil companies back then. And the reason for that was because they're paying massive or significant dividends with no free cash flow growth, no free cash flow positive in terms of looking at their statements. And so this was happening across the entire industry. That's not what's happening today. It's quite the opposite. So now, I think that that's still an opportunity, but it's really a basket of commodities that I think investors should be at least considering, where you have precious metals, base metals, you have energy, you have agricultural commodities, fertilizers, and one that is growing my conviction, that is Brazilian assets. Because I think if you're entering that sort of inflationary decade here, which I think we are, you want to own commodity-led economies, and I feel very strongly Brazil is one of those few ones that can really benefit in the following years.
As you talk about that whole basket, Tavi, many investors have heard many times that gold is a good inflation hedge, and obviously over the past 2 years we've seen dramatic inflation, and yet gold really hasn't responded. So, do you see that basket of commodities working better to hedge inflation rather than just one, let's say, particular metal or group of service sector focused on that one metal?
A lot of things to unpack on that, because we were basically long a basket of commodities for a while, but you just never know which commodity will lead the way. I mean, it looked quite easy to say today that oil was the one that was going to move, lead the way. But during those times when we were adding to oil positions, it wasn't as clear. And I know that because the sentiment was very bearish still at that time, especially when oil turned negative in prices and so forth. So you never know what the actual trigger is. And there's a lot of potential triggers for gold here. And I think one of them is truly a big problem in the global economy can actually drive gold prices a lot higher, just because of the fact that it is unsustainable. This rise of interest rates that we're seeing currently is just like I said, you have rise of interest rates, the dollar moving the way it is, and on top of you have the withdrawal of liquidity from global central banks. Those three things are simply unsustainable, and the global economy cannot handle that. So it has been of my view that if we have a severe decline in global markets, and I'm talking about the economy and in markets, equity markets and corporate bond markets, and even bond markets in general, I think it's going to be very positive for precious metals in the near future. But and remember back in 2008 when markets were collapsing, the silver market and the precious metals market really bottomed in November of 2008. The overall market only bottomed in March of 2009. And I'm not saying this are the same set of conditions that we have, but it's just important to see that things can bottom in different times. And I think that's a very high probability. But look, I've been of the view that gold is cheap. Not only that, but you can find miners that are extremely cheap today. I think there's multiple baggers in terms of opportunities of buying those things as of today. I mean, it's truly I would say fundamental multiples that we haven't seen throughout history. and people have lost their faith. I mean, if you read Wall Street Journal, for instance, just a couple weeks ago, they put out in the front page of their of the newspaper was saying that gold lost its status as a reserve asset. And just this weekend, we had another one on the Barron's cover talking about dollar being such a strong currency and so forth. And so, you just pay attention to the sentiment. The sentiment is as severe as it gets. So I don't know when it's turning, but it's important as a value and macro investor to be allocating capital towards that. And I'm not just long inflation. I have a bunch of short positions. And so that hedge is critical, because who knows if everything could collapse along with equity markets. When you have a flush, correlation goes to 1, everything sells off. Mm-hmm. So you have to have a hedge today. And as you make money on the hedge, you throw back into that inflationary asset. That's been our approach all year. It's been working. And I'm really focused and continue to do that. Make money on the macro and throw back into inflationary assets, because I think that's the opportunity over time.
So Tavi, do the energy and metal cycles tend to have any correlation throughout history?
Yeah, I mean, they can have a lot of correlations, especially, but let's say back in 2000s, both of them have early 2000s, they both had a bull market, which also coincided with things like Brazil. And don't get me wrong, Brazil got caught up in the tech bust too. But right after that, we saw a major bull market, and which that's why it deserves attention here. And I think that the timing of those cycles can be different because they have different lengths usually. So in other words, the mining industry, given the fact that the timing that it takes for a discovery to become a production story, it can take up to 10 plus years. While in the oil space, I would say that you can get a little shorter time frame, and therefore you can see the development of those cycles be shorter than mining. But I think given the political environment right now, and the pressure from shareholders of companies in general not being able to spend capital on things that are not currently generating free cash flow, so you have a true pressure from shareholders saying you should not be spending money on the ground for exploring for new natural resources and so forth, or developing something that will take years to be generating free cash flow. So the focus has been mostly on depleting current reserves of oil and precious metals and base metals and so forth in order to generate cash. And so this issue is causing another very interesting imbalance that I don't think we've really seen throughout history, which is companies, natural resource companies across entire sectors, from fertilizers, but mostly base metals and precious metals and energy. You can see that they're spending, they're providing more capital back to shareholders through dividends and buybacks than what they spend on capex. In other words, they're giving more money back to shareholders than what they spend on their own businesses in terms of investing for new things. And so it is a very unique environment, which I think will make this bull market for tangible assets in general a lot more sustainable than what we've seen in other times. And so, and then you can add on top of that back in 2000s, we didn't really see an inflationary problem, and as we see today. So I think more and more investors and really large capital allocators will start considering those tangible assets as part of their allocation and moving away from that 60-40, very popular portfolio positioning that we've seen over the last 20 to 30 years, and into things like commodities and gold, maybe serving more as that treasury hedge that it had been used over the prior decades. So I think there's a lot of changes that are happening right now, especially with correlations.
So, Tavi, as energy prices, let's say, namely diesel fuel, for example, keep climbing, how does this affect the metals producers? If the metals prices don't respond accordingly, doesn't this just keep compressing the producers' margins until they aren't profitable at some point?
It's terrible. I mean, yeah, absolutely. I mean, they're suffering a lot. And you didn't mention labor markets. Labor markets are more expensive too. The shortage of people, not because of what's happening with the pandemic. It's just because we have seen a secular decline in geosciences enrollments in undergrads and graduate programs across the globe. So there's no desire from folks to become geologists. And so, obviously that will have an impact on natural resource companies like we haven't seen before. So yeah, I mean, those and how do we going to have a green revolution when those companies are not even capable of producing like you would think they would? So it is a very, very challenging problem, I think. And so I'm a little worried about what's happening. I mean, if you think about the development phase of the mining industry, so you have producers, developers, and explorers. The developers are the ones really getting crushed, because if you calculated how much it's going to cost you to build something 2 years ago, that is at least double what it was 2 years ago in terms for you to build that. And you can extrapolate this whole idea. I mean, extrapolate that from a government perspective when they're going to, use capital for government spending on infrastructure. I mean, it's going to be a lot more expensive to do things as we move on, but there's going to have to be, and on top of it, you have the Fed tightening monetary conditions. So the availability of capital for the miners has been drying up as well. So it is a very tough environment for them. This is why, perhaps one of the reasons why we like to own exploration assets, because you're basically buying minerals in the ground. You get a lot more for what you pay for in terms of when they dilute themselves to use capital to explore. They can create a lot more value with that amount of capital that was used. So we've been deploying a lot of capital and exploration assets for those reasons. We also think that a lot of those companies are going to face a supply cliff issue over time. So they're going to be forced to purchase a lot of the high quality exploration assets. So yeah, I mean, it's while it is an opportunity to own precious metals and other commodities, it's been very challenging times to own those, as far as especially how they manage their own corporations with what's happening with the macro backdrop.
Mm-hmm. Tavi, does the entire, really the metals sector only really react to the Fed pivoting to be able to start moving again positively, or what other factors do you think could get the sector moving again?
I think, obviously the unfortunate situation of further escalation of war could create, not a sustainable, but a rise in commodity prices, but especially gold and silver. But I think you're asking a question of triggers versus a question of long-term play. The triggers, I think it has to be, I mean, you can turn the question around and say, I think you asked that question earlier and didn't really answer it, which is, you just had, this inflationary problem unfolding. How in the world is gold not moving? And you can see from those lenses, but what about the interest rate increase we've seen across the market, especially on the 10-year yields across the globe? So you've seen global bond markets completely collapse. And you look at the chart of global bonds versus gold, they used to trade lockstep. And now you see a total collapse in global bonds where, negative yielding bonds are non-existent now. And gold has been holding up very well. I mean, the dollar has been moving like it hasn't been moving in many years or decades, perhaps. And we're still seeing gold holding up very well. The Fed is basically taking a stance that we haven't seen also in many decades, and still gold is holding up very well. So, there are a lot of reasons to be bullish on the asset in terms of its performance relative to other things. And to me, it's very important to look at those relative performances. I can use the same example with Brazil. If you think about what the Fed is doing in terms of their policies right now, in prior times, what we saw was that the Brazilian real completely collapsed. in prior times, what you saw is when the Fed is tightening monetary conditions, the Brazilian equity market collapses. Why is it not collapsing? I mean, it begs the question. And the reason is, in my view, is because we're entering a different regime here, where it is an inflationary regime, where it favors commodity-led economies, it favors tangible assets. And so if you are a large capital allocator holding a large book of treasuries and equities that are both extremely overvalued historically, still, despite the sell-off that we had recently, what are you doing? You basically having to rethink your positioning and having to allocate some of your capital towards those things. And so as we see that happening, you start seeing the break of correlations. And I think it's very possible, back in the 70s, we saw interest rates rising while gold was rising at the same time. Both of them did, 10-year yields were rising and gold was rising along with treasuries collapsing. Today, I think that would be unthinkable, right? And still, I mean, a lot of people think that the correlations we had in the last 10 years have to be the case in the next 10 years. And it's not true. Mm-hmm. Things are going to change over time. And so I think as a macro investor, you just have to be very careful with those pivotal moments in markets. And we're having one. And it's not one day, it's a number of months that you start noticing different reactions, different behavior in some assets. And I think we're noticing a lot of that today. It's treasury markets collapsing along with gold holding up well. It's the equity market with the treasury market collapsing together. That's news. I mean, we haven't seen that since the 70s. That is, the Brazilian equity markets actually behaving better than developed economies. Whoa, unthinkable. It's like there's so many things happening here. It's China, the Chinese currency collapsing, and a lot of people thinking that China was that would never happen. And then you have the Japanese yen, the safest currency in the world for many, many years was supposed or perceived as the safest currency, now collapsing, right? And so you're seeing the gilts market collapsing. So there's a lot of big changes here that are being caused by those changes in positioning from big players. And so pay attention to those. And I think it's going to favor tangible assets, commodity-led economies, and do the opposite with things that are crowded. Technology still is crowded. Consumer discretionary is still crowded. Most of the global bonds are still crowded. So things are still, shifting towards a world that is going to be very different than what we saw in the prior 10, 20 years.
Mm-hmm. Yeah, it's interesting to think about and look at all of those correlations that are starting to break as we see basically interest rates break out of their decades-long trend of just keep going down, down, down. And then you see it break out and all of these other 60-40 portfolios, for example, that have worked for decades just end up breaking, right?
It's been, it's, I don't know. I think that the balance of powers are changing quite a lot. And I've been thinking a lot about that. And I think it's hard to believe an economy like Brazil, it will get caught up on a global economic bust, right? I mean, don't be naive. I mean, if you think, what's happening with central bank withdrawal of liquidity, rise of interest rates, and the dollar move won't cause a total break in markets, I think you're out of your mind, right? If you think that we're going to see junk bonds collapsing and the credit, and default risk really starting to increase and perhaps even surge, and you see VIX going to new levels and things like that, if you think we're entering a world like that, there's almost zero chance that Brazil is not going to get caught up into that. It probably will, but as you make money on that, you have to be reallocating that capital on things that are cheap. And some of the things that are already undervalued coming into this problem, right? I mean, Brazil is already extremely undervalued and miners are already extremely undervalued. I mean, I'm not saying dividend is a way to really value a company, but just puts into perspective. I mean, there are miners today paying more dividends than utility companies. I mean, you don't buy Newmont because of dividends. You don't buy Newmont or Barrick because of that. You buy it for other reasons. And but you buy utilities for those purposes because it's a defensive stock. It's more you can predict their free cash flows much better, which, by the way, have been negative for many decades already. It's kind of the same issue that we saw back with the energy companies in 2014. They're paying dividends with absolutely zero free cash flow. In fact, they're losing money every quarter, and then they add more to their debt problem. And so that's you look at staples, consumer staples. Oh my gosh, they're still, they're not like they were back in 2008, like when Walmart was able to, rally as the market was collapsing. Most of those companies in the staples world are actually levered, and like they were not back in those days. They're actually expensive. They're trading at growth multiples, and so the overall market still is expensive. And, investors are just naive, especially the guys in my age, absolutely naive about, this buy the dip mentality. I mean, it's going to be proven, I think, very badly as of now. It was a very good strategy over the years, but as of now, I think we are in one of those pivotal moments. And all that's left for a optimistic view here in the markets really is a technically oversold financial markets view. That's it. I mean, so you have macro versus technicals now happening here, and I think macro wins this, without a doubt. That's just my opinion. And so it's be careful with those technical oversold indicators that are telling you, oh, perhaps we're on to another bear market rally. You may catch some of those, but I think the overall trend is much lower. And as I said earlier, if you have the leading parts of the market already at March lows, I think we're going towards that in my view. And that's not 10% away from where we are. It's more like 30 to 40%.
Mm-hmm. Tavi, last week we saw a dramatic price spike for silver, one of the top 5 gains in price in a day ever. So does this type of volatility have positive precedents for silver?
I think it does. I think it's important to, I put out that chart of looking at the daily moves in silver because I thought it was such an important data point to look back. And it doesn't mean, the chart was showing basically the largest increase since November of 2008, which was the bottom of the silver market back in those days. And right after that, silver markets went up about 400% on the back of those, that daily move, but over time you saw the market really develop in favor of precious metals and other commodities. And I'm not saying the set of circumstances are very different from back in those days. Even the capex, I would say, profile of most of those companies that were in the silver and gold market at that time was very different than today. The M&A cycle was in a different position than what it is today as well. And so I think it's you just don't know when things are going to turn, but we're getting to something very extreme here. I mean, there are a lot of companies now trading below where they were back in the March 2020 crash. You're seeing companies trading with, in terms of fundamental values that are as cheap as it gets. And relative to equity markets, even though equity markets have been declining, they're still extremely cheap relative to those. And the gold and silver market, I mean, to me, silver has always been one of those markets where it fits into, not only the green revolution side of it, it's a monetary asset, it's an inflationary asset. It is something that I think it has the potential to have an explosive move. You look at gold to silver ratio today, it's at historical high levels. It's hard not to be, allocating a big chunk of your capital into things that are related to precious metals, given where sentiment is and where the potential macro drivers could be. So to me, it's if you are of the view that gold and silver are going to be higher, let's call 5 to 10 years from now, how do you plan out 5 to 10 years from now really making money on that trade? I think there's a lot of ways. Some folks are trying to buy the physical market. to me and to us at Crescat Capital, what we do, we've been buying a lot of silver and gold in the ground. So we like to buy exploration assets because that's the most inefficient part of the market, in my view. And that's a function of capital, lack of capital in the space, but also a function of lack of labor and knowledge to navigate that part of the industry, which creates those dislocations in price versus what they likely have in terms of the discovery. So I think, you're taking a venture capital approach, putting, a lot of capital into very diversified positions across the globe that you think are going to do well. And rather than the traditional venture capital approach where you make money on one or two investments and lose in a bunch of them, in today's price environment, you're able to allocate that capital into a lot of almost winning lottery tickets where they're already most likely onto major discoveries. And you're buying a lot of those winners at very cheap levels and you're holding them over the long term. So I just can't find those opportunities anywhere else right now.
Mm-hmm. Tavi, you mentioned earlier kind of being short, let's say general equities and being long other ideas. So at Crescat, you guys have several different hedge funds, whether that be your long short fund or global macro fund. So do these all really interact synergistically and serve a singular strategy working together, or are they kind of standalone pieces?
No, they're very similar. It's just the global macro has the flexibility of investing in any asset class. Long shorts is equity only, and so you sort of express that view through equities, and the other one you can express through, let's say, being short the Chinese currency. You can short German bonds, you can short JGBs, you can short the British pound. So there's a lot more different ways to express that view on global macro. But both, I stumbled into that chart from Incrementum AG. That they did on commodities to equity ratio, which we've been using that as a kind of a gauge of where we think positioning should be. And when you extrapolate that idea, it really is, incredible as far as the number of opportunities. I mean, to be long commodities and to be short equity markets. On the long side, I mean, we're doing this mostly on precious metals as far as that specific idea on exploration, but I think there's a lot of ways to explore here as well in terms of ways of investing in energy. Right now, we've been investing mostly in mid cap and large cap names in the energy space. Even folks that have an edge in places like Brazil, I think there's going to be a lot of good investments in that camp as well. Fertilizers look quite interesting as well, along with agricultural commodities. So you just kind of want to be all around, in my opinion, and really looking for those opportunities because, even I'm not a long housing market at all. I think that the rise of interest rates and other things can actually hurt housing market quite a lot. So I don't want to pretend like this is a great opportunity, but even the housing market relative to stocks back in the 70s during an inflationary time, investors really favor those the real estate investments over equity markets. So the ratio of real estate to equities actually went higher. In other words, real estate outperformed stocks during that time. And I think it's possible to see that today, but the housing market is also expensive. So it's not really, there's not much of an asymmetry to be taken. So yeah, that's certainly the way we think about it. Maybe global macro has a different twist because we have been long the dollar in that fund more than other, or it's impossible to do that in long short. It's possible, but in a more indirect way. And so I guess you get that part of it, which is I think it's a very attractive. I find it difficult that we're not going to see a major devaluation of the Chinese yuan. Just looking at what happened back in 1994, for instance, when they had to restructure their banks and the currency lost, 1/3 of its value on one single day. If you look across other times, it was a lot more than that. That's not priced in the markets. I mean, you look at implied volatility for that and the Hong Kong dollar and other things is still really, really cheap. So we like to be long those as in other words, long the USD versus those currencies. And that's a good. I think it's a good investment as well. That's just my view.
Mm-hmm. Excellent, Tavi. Well, I think that's a reasonable place to wrap up today's conversation. Do you have anything else you'd like to share with our listeners before we do?
No, thanks for having me again. And I think it's been a very difficult market to be an investor right now, favoring macro investors at this point. And so I just caution folks to be relying too much on technical oversold indicators. I really mean that, because it's I'm not sure that that's going to be a good gauge for investors in the following years, especially in this period right now that we're in, where I do think we're on to a big flush in equity markets and maybe a large contraction of the global economy, and where macro becomes a lot more relevant in this world where you start things really turning lower in general and correlations go to one. And so we're kind of seeing that right now. And so I think this is a time to be, very attuned to what's happening in the global economy, and pay attention to credit spreads and things like that, because those are going to be, when those things become dysfunctional, when those things, you kind of see those disorderly sell-offs in those parts of the market. I think that's when, the pivoting moment is going to be starting to be priced in markets, because that's just inevitable. And we all know that the amount of debt problem that we have globally is just unsustainable to see this levels of tightening of monetary conditions. So there's a turn on that too.
Mm-hmm. Well put, Tavi. Of course, for anybody that doesn't follow you, I strongly recommend following Tavi on Twitter because of all the excellent charts and threads that you post at Tavi Costa. And of course, all of your guys' stuff is available at Crescat.net. Thanks so much for your time today, Tavi.
Thanks for having me, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.